So when you look at where the restaurant industry is going, one of the biggest things that we always talk about is it's the backbone of America when it comes to small business. Today, we're going to actually dive into that with one of the best experts in the industry when it comes to finance, trends, and maybe where small business is going to be going. My name is Paul Barron, and this is the Barron Report. All right, so we understand you guys are out there in a lot of pain right now. We're still dealing with a lot of recovery issues. And then now, for the very first time in the past few months, we actually saw rent moratoriums come back into play. So there's a lot of things that are happening around the restaurant industry right now. So we thought, hey, let's get an expert on this topic. And with me today, I've got Danielle DiMartino Booth, who is the CEO and Chief Strategist with Quill Intelligence. Welcome to the show, Danielle.
It's great to be here. Thank you for having me, Paul.
Absolutely. So you're an article you put up on LinkedIn really caught my attention. I want to dive into it and really kind of talk a little bit about it. Before I get started there, I want to let our audience know a little bit about you. A global thought leader in monetary policy, economics, and finance. This is from your website. DiMartino Booth founded Quill Intelligence 2018. She's the author of Fed Up. Had a chance to read that book. Very interesting book, must say. Another interview, and why the Federal Reserve is bad for America. A full-time columnist at Bloomberg View and a business speaker and a commentator frequently on CNBC, Bloomberg, Fox News, you name it. You've got quite a resume here, so I think we got the right person on with us today. Let's just jump right into it, talking about small business and why you think this is a huge impact on where small business is today and what we've dealt with around the COVID-19 scenario.
Well, I think if we're speaking about restaurants in particular within the small business sector, we have to remember that while the shutdown affected all industries that were considered to be non-essential in the same way, the reopening of the economy has disproportionately been disadvantageous to restaurants because of the strictures that they rightly had to contend with in terms of social distancing and proper safety measures. But that means that even as economies around the country reopen, they're not able to reopen in a way that we think of as being their profit model. A profitable restaurant is a restaurant where there's an hour wait to sit down and it's super crowded. And that is, we have to think about restaurants' cash flow. They typically have a matter of days, and in the best cases, weeks, 1 or 2 weeks on hand of cash flow, and they run with very thin margins, and it's all about volume, volume, volume.
Right.
What's happening in America today is the absolute opposite of what helps businesses be profitable.
Yeah,
restaurants.
Definitely. When you look at small business America, the restaurant industry really leads the category because they're the number one employer when it comes to small business. They're the number two employer in the United States next to healthcare. At least pre-COVID, we were at 15, almost 16 million people employed in the industry. Now we are at a dismal less than 9 million employed in the United States, which is an absolute travesty that's hit this industry. And of course, you know, there's a lot of experts that are speaking out on this. We, of course, are dealing with us in terms of the state associations, the national associations, actually proposing some support through government to help these smaller businesses. But I'm kind of curious of why you think government in general has had a hand in what's happening here to small business. Why do you think that is actually occurring? Because I see a lot of plays potentially on the back rooms and the boardrooms potentially happening here. What are your thoughts on why you think this might be happening out there?
Well, there are various reports that can exemplify that large businesses, especially large publicly traded businesses that have access to the capital markets, they're going to have a bigger lifeline, if you will. They're going to have a bigger grace period, even if they're a large restaurant chain. Again, because they have access to these financing vehicles that small businesses do not. The Paycheck Protection Program was designed to cover 75%, and then it was reduced a bit in term. But the main thrust of the Paycheck Protection Program was covering the cost of retaining employees. But again, if you don't have access to further financing, and if the state that you're in or the city that you're in says that you can only open up to 25% or 50% of capacity, such that you have to take half the tables out of your restaurant, well, by definition, it doesn't matter if you're being paid to keep, you're literally being paid to keep employees on the payroll who cannot work by law. Yeah. As opposed to, again, larger corporations fed by Federal Reserve money printing and quantitative easing, which has helped open up the junk bond market, which is where these large restaurant chains are indeed borrowing. It is the junk bond market. But disproportionate benefits in terms of finding a capital bridge to get past this to where the country's truly fully reopened. And I don't necessarily know that we can answer when that is going to be, because we don't know if there's going to be a second wave of the coronavirus or not with colder temperatures.
Yeah, we just did a survey with consumers that looked at consumers' response in being able to go back into restaurants. I think the number was around 30% that said, hey, I'm interested in going back into a restaurant by year's end. We were looking around a little over 40% by Q1 and just 60% by the end of next year, 2021. So when you look at the unit economics of a restaurant operator, 60% capacity is a failing restaurant. And that obviously can't be a scenario that restaurant operators are going to be able to contend with. So if you're looking at where government is today, there's still a lot of PPP money that's been left on the table. I think it was over $135 billion. There's still out there unused. And why do you think maybe government is not throwing that lifeline out? I know we are going back into another session here, trying to finalize a deal for the third round, so to speak, of potential small business support. Do you think that's really going to help American small businesses, though?
I think it would have to be much more directed at the restaurant industry in particular, because if you're talking about especially small restaurants, you're literally going to have to provide them with a much longer grace period, a different kind of financing, one that is not so attached to the number of employees that you have, one that understands that restaurants are taking on a higher cost burden in order to be safe, in order to turn tables and make sure that they're fully sanitized. So these are not free things, that they're extra burdens that fall upon the shoulders of the owners. So I would say that if there is money and wherewithal in Congress to extend further leeway to the restaurant industry, that it would need to be very targeted, very directed, and designed with the people who run these agencies who are making pleas for the restaurants.
Yeah, for sure. All right. So in the book, Fed Up, you go into the Federal Reserve and kind of really why this is a bad thing for America. I'm kind of curious, what are your thoughts on how the Fed is playing into this? Because obviously this is a huge trickle-down effect into our economy. How money is being able to be pumped into especially when you look at the restaurant industry. That's $1 trillion industry by itself, pre-COVID. What are your thoughts on how the Fed is potentially affecting this industry?
Well, so when I say trickle down, I actually mean trickle down in the worst possible way.
Right.
So, sadly enough, and the Fed is trying to actually get out in front of a lot of the larger bankruptcies that we've seen, but because we've had 12 solid years of corporate America doubling the size of the debt on its balance sheet, when we do see Chapter 11 bankruptcy filings with larger companies, unfortunately, because they're so overladen with debt, they tend to not be able to even restructure, and they have to go straight into liquidation. Now, if a large company liquidates, then that's going to take a gigantic chunk of employees away from a given community. And what does that mean for the restaurants? That doesn't, if you think about central business districts, if you think about headlines saying that leases in New York City proper, in Manhattan, are down 64% year over year, the lowest level in 2 decades. All of these restaurants that cater to businesses being open and vibrant and full of employees are also suffering because they simply don't have the patronage that they had before. And it's difficult to figure out when that is going to happen. But again, We've had a record number of bankruptcies. We just came through a record August where 30 companies that were larger than $50 million sought out bankruptcy protection, filed for Chapter 11. Every single time you see a big business go, it is going to have collateral damage that trickles its way down into the small business sector.
Yeah, for sure. And when you look at the restaurant industry, there are really about 4 or 5 categories of restaurant concepts. You go from the level of a Starbucks, McDonald's, Burger King, et cetera. Publicly traded companies that have tens of thousands, if not thousands of locations, millions of employees. Then you move into these regional chains, which really kind of populate the land and make up a good amount of the industry itself. And then you drop into the independents and the high volume independents, which really are the backbone of the industry when you look at the total numbers. Even though their employment numbers are about equal to that of the chains, their unit count is actually greater. It's about 70% to 80% of the market. Here's my question to you. When you look at those businesses being affected the most, the number one thing, of course, they are going to have in being able to not be able to pull out of this, get their head back up above water, is one, job loss, which is a natural. We know we're already down under 9 million, which is a massive hit to our industry. But number two, the one that I'm really watching is the real estate impact. These are in many cases cornerstone A locations, commercial real estate property. If you look at fast casual, one of the categories we cover here, I would say 70 to 80% of those fast casual chains, there's almost 800 of them, live and breathe in these urban communities like New York, Chicago, Los Angeles, Seattle, Portland, Oregon, many of which have started to vacate their properties. So this is just the beginning. Rent moratoriums now off the table pretty much in all the states. It's coming back in, so evictions will start. What are your thoughts on how this is going to flow into the real estate market? Is this opening up a huge bonanza for others to be able to pick real estate up at a cheaper price?
I do think, and I have been writing about the fact that there will be opportunities in commercial real estate, the likes of which we really haven't seen for decades, plural. The Federal Reserve, when it stepped in the aftermath of the housing bubble bursting, and it took rates to the zero bound for the first time. If you were in commercial real estate, you were able to really get through. It was a calamity. It was a recession, no doubt, but the financing was there almost immediately.
Right.
In this current episode, commercial real estate has been largely left behind by the Fed's bailout efforts. And so if you speak to investors in this space, they are indeed looking to try and scoop up some true bargains, because they're seeing all the way from malls that are not maybe, we can anticipate that the nicest malls in the best zip code may make it, but we're even hearing stories about entire mall operators going out of business. But now you're starting to hear anecdotes about strip malls and how pressured that they're going to be. So yes, commercial real estate is definitely going to be an area where nimble investors can come in and quote unquote make a killing. But again, they'll be potentially overpaying at this juncture, which is a cruel reflection for what remains to be seen for the small business sector. I'll give you a little statistic. The U.S. Census Bureau has been doing some extraordinary real-time work querying the small business sector, and in its most recent survey for the week ended August the 27th. So we're talking about fairly real-time data here.
Yep.
9% of small businesses said that they were going out of business forever, that they've closed their doors. 47% of small businesses said that they didn't anticipate things being back to normal for 6 months or more. Lo and behold, if you look at the Bureau of Labor Statistics, if you look at the July data from the Bureau of Labor Statistics, 47% of the pool of temporary unemployed sit in a bucket of between 15 and 26 weeks. And there is your 6 months. There is a massive pool of potentially permanently laid off workers who are hoping that things get better. And a lot of them are in this small business sector, the same 47% who are saying, We hope we can make it for another 6 months because that's about all we're going to have. But there's
Yeah.
tons of uncertainty because of this virus.
So, okay, so that has some very interesting effect on the industry, and we've talked about this with pundits here on this show many times and with experts around the impact of the consumer. Because I saw one of the charts you had up on Twitter last week. I was kind of perusing through some of the things you were talking about. One thing that I noticed was the chart you put up on the amount of, not evictions, but mortgage foreclosures or actions on people not being able to pay their mortgages.
Right.
It had spiked literally to a level that was almost equal to back in 2008 and 9.
Right.
So we're at a space, and we're still somewhat very early on. I feel like we're still at the leading front of where the real economic impact is going to be hitting America. So what are your
Absolutely.
thoughts on that when you look at consumer real estate in the next 6 months to 12 months?
We have not even begun to see. In fact, housing has accelerated. You've seen subprime automobile delinquencies decline when traditionally at this seasonal time, this is when we would be seeing them rise, because again, we're seeing the effects of $600 a week extra in unemployment benefits that have helped people keep their rents up, keep up their payments for their cars like they couldn't do before. Now that's coming down. We think now that that's going to be replaced by up to 3 weeks of $400 a week. But my point is, we've not seen the beginning of the household credit cycle. Forbearance measures you can request forbearance for up to 12 months, which means that we're not going to see lenders begin to foreclose on properties, despite the fact that we're seeing near record delinquencies, as you note. But lenders are going to have their hands tied in terms of pushing through foreclosures until March of 2021. That's a very long time.
Right.
But again, it's difficult to assess what the true landscape is in the household sector because so much of the credit cycle is completely frozen. By now, we would be seeing massive evictions and massive foreclosures, but we're not because of some of the measures that were taken in the CARES Act. I wouldn't want to be the landlord. I wouldn't want to be the lender because they're also being put in a very precarious situation.
Yeah. And you know, when you look at it, because that's the big scenario, the backbone of these small businesses is in many cases their retail location. Obviously, that has the effect on the commercial property. But the point I was making is that with consumers right now, you know, maybe they can get back out in the restaurant industry, but I'm concerned about the long-term effect of them just not having the cash and most likely being very challenged to even keep the home they're living in when you look at the end of 2021 and possibly into 2022. So this could really be a train wreck that is heading down a track that the industry itself, small business, especially the restaurant industry, almost feels like there could be a slight recovery and then basically a left hook that could wipe us out in the next 18 months. When you think about that and you look at the access to capital, the easy access to capital, do you feel like these small businesses should be putting it on the line right now and kind of doubling down? Or do you think this is a time to really reconsider your entire business proposition and maybe change the game of how you're doing business?
Well, I think it's, maybe if you're in a very sparsely populated state with absolutely no density and you feel like you can get through a potential second wave, you have to consider all of the variables. But to your point, and this is a thought that has crossed my mind, if you know that you are a successful restaurateur, if that is what you do and it is what you do well, then there's something to be said for not throwing good money after bad, such that you've got a chance to come back and reinvent yourself. Because in many ways, that's what a lot of these entrepreneurs are going to be faced with, is trying to get by and look after their families, their own families. Because as you say, it appears that household budgets are going to be more and more constrained as a factor of time, as a lot of these forbearance measures, eviction moratorium measures, as a lot of these come off, households are going to be more and more constrained in their ability to just cover the car payment, just cover the rent, and just cover the grocery food bill, and forget about ever being able to eat out until they get past it. So if I'm a restaurateur, I'm certainly trying to bring all of this into my decision-making process.
Yeah. All right. So we've talked a little bit about the economy, where real estate plays into this, because obviously viewers of our show are small business entrepreneurs. These are people that are trying to look for, answers on really it's kind of hedging your bet a little bit. And I talk to operators all the time, restaurant operators and entrepreneurs that are actually considering scaling back operations, restructuring the way they do business, going into secondary classification real estate. So they're reducing their A-class real estate and getting more into what they call virtual or ghost restaurants. So it reduces employees, overhead, all those kind of things. With all that being said, and let's move on to kind of the outro subject here, and that is getting into how government in general has dealt with COVID-19 and whether or not government can be applicable to help small business in 2021, because that's really kind of the period I'm most concerned about, is really latter 2021. We're past the election, not knowing what president we're going to have in office at that time, but I feel like they're going to have a real mess on their hands. What are your thoughts on how the Fed is going to respond to something that we could see another spike in huge unemployment and another major hit on small business? How do you feel like the Fed's going to respond to that along with the government?
Well, I think that the Federal Reserve has already made plain that it is happy to effectively monetize any fresh stimulus legislation that is passed, whether it be $2 or $3 trillion, that the Fed clearly has an unlimited appetite to go into the secondary market and buy as many treasuries as are created in order to fund the next iteration, whatever they may look like, of stimulus. As far as the fiscal authorities go, again, I'm going to go back to what I said earlier, and that is, if you are somebody who has to reinvent yourself, maybe the Small Business Administration should be part of helping the next generation of restaurateurs who have had to shut down, reinvent themselves, find a way to get past this, but such that if people know that they have to close their doors today, that there's going to be an avenue when the dust finally settles on however long this recession is going to be, but that there be some kind of extra special, extra lenient terms, loans that are literally waiting for them when it comes time to recover, because they're well-known, efficient, good business model operators who have been displaced by something that was out of their control.
Yeah, for sure. Okay, so that's an interesting angle to go the SBA route, because I think even though the EIDL loans were a lifeline to many businesses, and in most cases those were great terms. Many cases their loan payments don't start for a year. I think it's a 30-year loan, so it's a very low interest rate. It's almost like free cash to most of these operators if they can stay in business and it can help them maintain in business. Which it will be interesting to see how the SBA rolls into that. When you look at the Fed and kind of with quantitative easing and kind of this whole restructure over the past 25 years, do you see us actually going into negative interest rates? Kind of curious.
Well, I think negative interest rates is a truly, I don't think we'll see it before February of 2022. That is when Jay Powell steps aside. He is adamantly opposed to imposing negative interest rates. And that is why he's said that the Fed can do unlimited amounts of quantitative easing, grow its balance sheet to whatever size needs to be, and or impose yield curve control if rates were to start to increase, which is exactly the opposite of rates going the other way and going negative. The market, there's a chance that the market could force the Fed's hands if we were to see nominal interest rates as opposed to inflation adjusted interest rates. But what we look at on the screen when we see the 10-year Treasury yield quoted, if that was to come down so low that it was to flirt with negative territory, that would certainly get the attention of policymakers at the Fed.
Yeah, absolutely. Whew. Okay, not getting political here. Do you think this plays into Trump's hand or into Biden's camp in terms of how this plays out from a small business side of things? Because it still seems as though there is a false recovery underway, and it's likely that one of these two are going to take an advantage point into the election. Obviously, I feel like we won't even know for months maybe who our president is after this all, but I'm kind of curious. Who do you feel like it plays stronger to, Trump or Biden?
Well, the thing is, I've actually got my opinions on both, and I certainly don't want my taxes going through the roof. But what I would say is that because the the fiscal alternatives for small businesses have also been under the design of Congress that, and as you said, 130 some odd billion dollars
Yep, still
of
sitting there.
effective small business funding left on the table. I would say that whoever's in a position of power would make sure that to recognize this wasn't taken up fully, therefore its construct was incorrect. And this is not how we should have addressed distress in the small business sector. So we need to go back to the drawing board and make sure that whatever we do is of a better design than what the PPP was. And that's really what I want to see. I want to see whoever's in the White House work closely with Congress, but first and foremost, acknowledge the failures of the first attempts that they put out there to help out small businesses, because it didn't work.
Yeah, for sure. I think they just had under the gun, granted, definitely probably making a lot of rash decisions very quickly, which are usually when the mistakes occur. And if you look at some of these bills, I mean, these things are enormous. But that is a factor. But if you look at the president as they get past this, 2021 is definitely, they're going to inherit or evolve into a very big problem in terms of a recession going forward. I'm kind of curious, if you could create the perfect advisory group, because I like the idea of the SBA getting involved and really being active. I know they were a little bit in the PPP program, but I like the SBA. And especially if we could get the National Restaurant Association, I know they've proposed a big bill in Washington to try to give, I think it's about $145 billion of direct relief to the restaurant industry. What other entities out there in our communities, whether it's state, local, or maybe at a national level, could maybe come together and really put a bunch of good brains together to figure this out? Because we are set for something that's going to happen most likely early 2021. Who would you say, if I could create a dream team together, this would be the dream team?
Well, so I would hunt down the one state's most successful reopening process and see which state small business sector is doing the absolute best. Okay. And then I would find whoever's in charge of their health department and say, this was the most efficient and effective way to reopen in a post-pandemic world. Because if you listen to small business owners, one of their chief complaints is, I've got this entity telling me to do this and this entity telling me to do that. I don't know what to do, so I'm just going to close my doors or throw up my hands. So I think the need to have continuity in the messaging means that you don't just have to have the people who are concerned about the financing and the legislative authorities who can pass the bill to give the money, but you actually have the person who's going to be saying, I don't care if you have the money, you still can't open. They all have to be on the same page.
Yeah, for sure. Listen, Danielle, it's been great having you on the show today. I love your insights. I'm going to keep following you. I'm definitely going to continue to read your writings, because I think you guys are onto something over there at Quill Intelligence. What else do you guys do there? I mean, we want to give you a plug. Where do you focus your practice at right now on Quill?
So Quill Intelligence has two suites of products. One is for more of a retail-oriented trader type of investor. Every day we publish the Daily Feather every trading day. And then we have an institutional product that is geared more towards money managers, hedge funds, family offices. And that is a whole host of a huge weekly deep dive. You mentioned the Trickle Down, in addition to the daily that they get, and then actual investable ideas that we produce for them, and access to me above all else. So two different parallels for two different budgets. Yeah,
absolutely. All right, for our viewers, listeners, readers out there, of course, you can find Danielle over at DiMartino Booth. And thanks again for stopping in on the show today.
Thank you. Thank you for having me.
Absolutely. All right, so you guys are listening maybe over on the podcast stream right now, whether you're on iTunes or Spotify or even on Google Podcasts. Make sure and give us a rating. That's how we get your feedback. And it's also how we learn about great guests that you might want to hear from here on the Barron Report. Just shoot us an email to producer@foodabletv.com. And of course, you can always hit me up on Twitter @PaulBarron. We'll catch you next time right here on the Barron Report.